Bitcoin has lost 80% of its value 3 separate times and recovered each time to set new all-time highs. Every cycle, the same pattern plays out. Retail investors buy the top in euphoria, panic sell during the crash, and miss the recovery. Every cycle, the same people say this time is different. Every cycle, it is not. Understanding how crypto market cycles work does not guarantee you will time them perfectly. Nobody does. What it does is prevent you from making the catastrophic errors that destroy most retail portfolios, buying late in a bull market because of FOMO, and selling during a bear market because of panic. The Bitcoin halving, the engine of the cycle. Every approximately 4 years, the Bitcoin protocol cuts the block reward in half. In 2009, miners received 50 BTC per block. After the 2012 halving, 25 BTC. After 2016, 12.5 BTC. After 2020, 6.25 BTC. After the April 2024 halving, 3.125 BTC. The halving reduces the rate at which new Bitcoin enters circulation. If demand stays constant and supply decreases, the price tends to rise. Historically, the 12 to 18 months following each halving have been the most aggressive bull market periods. This is not a guaranteed mechanism. It is a supply shock that interacts with demand, sentiment, macro conditions, and liquidity. The 4-year halving cycle has been the dominant structural driver of crypto market cycles since 2012. It is not the only factor, but it provides a temporal framework for understanding where we are in the cycle. The 4 phases of a crypto market cycle. Phase 1. Accumulation. After a major bear market bottom, prices are low and sentiment is deeply negative. Trading volume is thin. The mainstream financial press has declared crypto dead. Long-term holders and institutional investors quietly accumulate. This is the best phase to be in the market, and it feels the worst. Phase 2. Early bull. Bitcoin begins recovering. On-chain metrics improve. Institutional announcements start appearing. Retail has not returned yet. This phase feels cautiously optimistic but uncertain. Phase 3. Euphoria. Prices are setting new all-time highs. Every major news outlet is covering crypto. Friends and family are asking how to buy Bitcoin. Altcoins with no utility are rising 50% per week. YouTube influencers are making price predictions that go to infinity. This is when the risk is highest. This is when most retail capital enters. Phase 4. Bear market. The catalyst varies. A hack, a regulatory action, a macro shock, or simply an exhaustion of buying pressure. Prices drop 70 to 90% from peak values. New projects from the bull market fail or disappear. The media declares crypto dead. This is the reset phase before the next accumulation cycle begins. How to survive a bear market. The single most effective strategy for retail investors is dollar cost averaging, investing a fixed amount on a regular schedule regardless of price. When prices are high, you buy fewer units. When prices are low, you buy more. Over a full market cycle, this approach outperforms most attempts to time the market. Never invest money you cannot afford to lock up for 4 years. Crypto bear markets can last 12 to 24 months. If you invest rent money in February and need it in August, you will sell at a loss no matter what. Stake or put your holdings to work during the bear market if you are confident in the underlying assets. Ethereum staking currently yields 3 to 4% annually. This compounds your holdings during the period when prices are recovering. On-chain indicators worth monitoring. MVRV Z-score measures whether Bitcoin is over or undervalued relative to its realized value. When the score enters the red zone, it has historically marked cycle tops. When it enters the green zone, it has marked cycle bottoms. It does not predict exact timing, but it contextualizes where you are in the cycle. The Bitcoin pool multiple compares daily miner revenue to its annual average. High values indicate miners are generating unusually high revenue, historically a sign of overheated markets. Low values have corresponded to bear market bottoms. These indicators are descriptive, not predictive. Use them to inform position sizing and risk management, not to make confident timing calls. Conclusion: market cycles are not perfectly predictable. Anyone who tells you exactly when the top or bottom is has already lost money being wrong before. What is predictable? Human psychology in markets is consistent across every cycle. Fear and greed move in patterns. Understanding those patterns lets you position yourself as a buyer when others are panicking and reduce risk when euphoria peaks. That discipline, consistently applied over multiple cycles, is what separates the people who build wealth in crypto from the people who lose it.